And
This
I also had
conference will
another
now be
question.
recorded.
Do
Go
you
ahead.
remember you remember the Excel you showed me when we was in your office? Is that project that's part 3, right? This isn't what we're turning in, right? I just want to make sure.
Correct. What you turn in are your assumptions.
Okay. But so what you showed me, that's gonna be like the final part of the project, but this part is just part 2, and that's gonna be due when we come back.
You have to get to the final part.
Okay,
We're
okay, just want to make
doing
sure.
assumptions.
All right.
So your assumptions part 2, I think it's due on Tuesday, next Tuesday. And then year 1 of the project by the team lead or that person designee will be due the following Tuesday. And of course, it has to be done correctly. And then everybody on the team completes a year. Okay, let's see. I can share my screen. So we're moving to your project, and everything we're working on is something that you're going to utilize as you do the project. We started off with cost, volume, profit analysis. And with your project and everything that we're working on, it's how many you got to make to break even, or your net income is zero. How many you got to make for a profit of 1 million, 2 million, 3 million, depending on the number of members on your team. Then how many you have to make so that your loss is 100,000. So the team leader designee is doing this one. We looked at an example last time where we had a merchandising company and we had some assumptions. Key one was those sales were quarter 1, 2, 3, and 4. And most of the sales were in the fourth quarter, but we had that fixed expense of rent every month of 1 million. And so we had to prepare a budget to see when we were going to come up short and make plans in advance to have a short-term loan at the bank so that we could still always keep 100,000 in cash in the bank. And when the fourth quarter came around, we would, you know, then have our excess cash back. We'd pay off the loans and have our ending cash. And we stated, you never get to this point. You never get to this point unless you got those temporary loans in the short period. Any questions on this example? We went over it last time. So this is what we're going to be doing. And remember, we had the sales and beginning cash available. Then we looked at the disbursements. So with your project, we're doing the same thing, but because we are making a product, it looks they're more. We use schedules and bring them back to the master to the cash budget, and so we have to uh, look at each item in our budget, to make the item, and still do a cash budget, a budgeted income statement, and a budgeted balance sheet. So your project will consist of all of these schedules, a cash budget, a budgeted income statement, and a budgeted balance sheet that will all tie in together. So in the master budget process, you got a sales budget for your sales. You got a production budget. Then you have a raw materials budget for each raw materials. uh, your direct labor, your manufacturing overhead, selling expense, administrative expense, the capital expenditure budget. So with these budgets, you're going to do two things. First of all, you're looking at the cash expenditure amount, and that's going to go on the cash budget. Then you will be making journal entries, preparing a trial balance so that we can get to the income statement and the balance sheet. There's a cash budget quarterly. There's an income statement that's for 12 months, and the balance sheet is for 12 months. And these items all tie together. And we have an example that we're going to go through, and we'll begin on that example today. What we do on this example, you've got to do the same thing. You got to do the same thing on your project. We're making something, so instead of just purchasing inventory, we got to buy raw materials, pay labor, pay overhead, etc. And so it's a little more involved than if we were just buying something and selling it. And so what I have in here is a discussion of what you got to do with each one of those budgets, along with the journal entries you got to make. So the only way we can get financial statements done is that we have to make journal entries, okay? The only way we can get financial statements done, the income statement and the balance sheet, we have to make journal entries, get to a trial balance, and prepare those statements. So journal entries have to be made. So our first budget, it's going to be sales and cash receipts budget. And that's done on a quarterly basis. We determine the total units to be made, then we break it up quarterly. We have to have sales percentages, sales quantity, uh, utilize our predetermined selling price, calculate the sales by quarter, bad debts, uh, and we'll look at an example in a little while on all of this. Uh, Determine how much we're going to collect. Collections are the cash sales plus collections for the quarter. And we transfer the quarterly and total collection to the cash budgets. Then we make these journal entries uh, so that we can get to a trial balance to do the balance sheet and income statement. So the schedule does two things. It tells us how much cash we're going to have. All the budgets do that. And then it has these set journal entries that have to be made so that we can get to eventually to a trial balance. So with your project, you got to do all of this with that project to complete what we need. There's a production budget that determines how many we have to produce. There are no journal entries with the production budget, just quantities. But once we determine those quantities, then you got to buy a certain number of raw materials and then pay for those raw materials. And we don't pay it all in the same quarter. But for each raw material on your project, you got to have one of these budgets. Here are your journal entries. Direct labor. You've got to determine the hours that are going to be worked. Here's your journal entry. So all your journal entries are here. Manufacturing overhead, how much you're going to pay. These are your journal entries. Selling expense, journal entries. Administrative expense, journal entries. Capital expenditure budget, journal entries. cash and operating budget journal entries. And once you've gone through all the schedules and once you've gone through uh, determining what cash goes on to cash budget and you posted those journal entries, prepare the trial balance, then you can prepare your income statement and your balance sheet. Now that income statement is a direct costing income statement with variable costs at the top and fixed costs at the bottom. So we'll be coming back and looking at all of those. Uh, and what we're going to do, we're just going to go schedule by schedule. First off, uh, first thing though, you got to have your assumptions. See, these assumptions, this is what you're preparing for me for next Tuesday. What are your quarterly sales going to be? What's your selling price going to be? And it's going to be a percentage of your variable cost. All the sales will be credit sales. Okay, so that will help us. All the sales will be credit sales. All teams will use a 10% for the bad debts. So your bad debt expense will be 10% of the sales. And then you're going to collect 40% in sales in the quarter that you collect them and 50% later. You got to design ending inventory. You can't run a company unless you got to make what you need. Then you got to have inventory on hand to sell at the beginning of the next period. Then you put in uh, your raw materials, how much they cost. As we have in this example. So you've got to do the same thing, but based on your costs. You got to have a direct labor. You got to come up with your overhead and the depreciation. Your selling expenses, uh, let me just change this on here a little bit. On your project, I want you to use 20%, so I'm just going to change this to 20%. So on this handout, just make this 20%, so we're using the same thing that's going to be on your project, 10% and 20% as we go through this example. And you're seeing where you've got your overhead, then the depreciation in that overhead. You got an initial cash balance, a minimum cash balance required. And when you buy your equipment, you're going to buy it with a note and you're going to pay back principal and interest quarterly. But the equipment that you buy is with a note. You've got to have all of these assumptions for your project. So that's what's due next week. Also, what's due is your master budget quantity solutions for your project. What's it going to look like with a target loss, break even, target profit? And you should have uh, your spreadsheet all prepared and ready so that you can prepare this. So you should be in. Uh, and what's going to happen? The team leader is going to do this year. The next person co-lead, break even, and we go on across with everybody responsible for a year. And I grade each person's year separately. Now, the first year has carryover things for the second year, which has carryover things for the third year. So the chair has to make sure, a team leader has to make sure that that first year is correct, you know, as we go through this process, because the subsequent years are based on that. So so we gotta have the schedule prepared. And then here is the sales budget, cash receipts, etc. So let me do one thing before we go back and begin to work on this. And let's look at your uh, tuition that you pay to TSU. So in August, you received the bill with your tuition on it, which to TSU is sales. I'm going to put August here. I'm going to put September here. I'm going to put October here. So let's assume that your bill in August was $10,000. That's the revenue. Okay. You had a payment plan. Your payment plan, so the cash receipt for TSU was that you're going to pay 50% in August and then 25% each month after that. Okay, you're going to pay 50% in August. So how much would you pay in August? You pay 5,000. So TSU gets 5,000. So even though the sales was 10,000, TSU only got 5,000. Then when we got to September, sale is there. TSU gets 2,500. That's their cash receipt. And then in October, they got 2,500. Okay. So even though a sale may be for a certain amount, you don't collect it until later. So just make a note of that. Keep that in. We'll make a sale, but the collections will be later. So let me see if I can. Okay, let's get back to our main problem again. And in this problem, like I said, you got to have assumptions also. And I just got the break even year in here. Our quarterly sales are 10, 20, 30, and 40. You can use these on your project. And we went with a selling price of $500. Okay. So that's what we went with. And these sales are all credit sales. Our bad debts were going to be 10% of sales, $50. And so we were collecting 40% in the month of sale, 50% the month after sale, quarter after sale. So these months should be quarter. But we aren't, even though we uh, sell something, we don't get it all that quarter. Our design inventory is 50% of the next quarter. We had 5 ink cartridges. and the ink cartridges were $10 each. So, you know, I got my unit cost in here, and you should be doing the same thing, $50. The paper was $7 each, $49. I make 20 books an hour, $1. The manufacturing overhead, we look at we had it quarterly for the whole year is 100,000. Appreciation, we don't worry about that yet. Selling expenses, I think we said we were going to make these 20% of sales. Because that's what I want you to use on your project. Your administrative expenses, 200,000. It's the total before the depreciation. Then we had the interest expense of 25, 25, 25, 2500. So I got those in red. So when we get ready to work on our quantity solution, that's that's the thing that comes after these assumptions. We've got to determine what's our quantity going to be. Like I said, I gave you a selling price of 500. Okay? Then for the raw materials, ink and paper, there were $50. So for the ink, 50, for the paper, 49. Your labor was $1. You could make 20 books an hour. Your bad debts were Timothy's selling price. So bad debt becomes a variable expense, $50. And then your selling expenses were 20% of the selling price. So that's $100. So we go from our assumptions to fill us out in detail for our project. And so in this case, uh, these are what our numbers are. And so we're pulling these, we're doing the top part and getting ready to get our contribution margin. And so I just tell you to, with your assumption, just do it like this so you can come in here and put these in. So we add all these costs up, 100, 150, 200, 250. So our total variable cost is 250. So our contribution margin is 250. Any questions? Any questions on how we got these numbers? We pull them from your assumptions. So these are the assumptions in this problem. These are the assumptions in this problem. And so we pull out relevant things that are going to go. We pull out relevant things that are going to come in here to calculate our master budget quantity solutions. These costs are always variable. Selling, bad debt, your labor, and your raw materials. On your project, you have your raw materials, labor, bad debt, and selling. These are all variable costs. Your fixed costs will always be manufacturing overhead, administrative expense, interest expense. Those are always your fixed costs. And so when we look back here at our assumptions, the interest expense was 100, administrative expense 200, and manufacturing overhead 100. So 100, 200, and 100. But we need these for the full year. 100,000, 200,000, 100,000. Our total fixed cost, our total fixed cost would be 400,000. But with that total fixed cost, what's our break even quantity going to be? What's my break even quantity going to be?
16,000.
16,000? I will take your word for it. If
I
we
got
lose,
1600.
somebody says 1,600.
100, my bad.
And what about if we lost 100,000? What would the quantity be? Keeping in mind that all of these are going to be the same. So what's the quantity going to be if we lose 100,000? Can't hear you.
1200.
What's the quantity going to be to make a million?
5600.
5,600.
Yes, sir.
But when you're doing your project, and of course you got the one, the one in there also. But you got to, for all the people on the budget, everybody got to do a year. So you got to show this for, like I said, going from a million, 2 million, 3 million, 4 million, 5 million, to you cover everybody on your team, and everybody has one of these years they're working on. All right, let's go ahead and prove the break-even year. So what's our dollar sales amount? It's 500 times 1,600. Is that 8 million?
800,000.
All right, 800,000. What's your variable cost going to be?
400,000.
So the contribution margin is going to be what?
It's gonna be the same, so 400,000.
Fixed cost of what? 400. So your net income is zero. So what you got to have from me on Tuesday when we get back, all of these assumptions for your project. Then you got to have these master budget quantity solutions fill out with the person responsible for each of these years. So team leader, designate the target loss of 100,000, the break even year person, the million, 2 million, 3 million. You have that designated, so I know who's working on each set of statements that you have to do. Because when we begin to work, you see these schedules, each year has this set of schedules. Each year has this set of schedules and the journal entries. Each year has that. So, and we're doing this to determine whether we need to borrow or not. Okay, so each year has that with journal entries. What the cash budget is. Okay. So now we're ready to begin on the schedules. And the first thing we're going to do when we get ready to get on the schedules, this quantity we came up with, we're going to copy it and we're going to put that sales quantity right here. So hopefully you're beginning to see that that sales quantity needs to be correct. Then we'll come up here to our sales and we had them. These are the quarterly sales. Copy these. So these sales in here, 10, 20, 30, 30, 40% to 1,600. So now we have to begin to put in, okay, we got to break these sales down by quarter. And so in the first quarter, those sales are going to be what? 160. In the second quarter, the sales are going to be what? 320. In the third quarter, the sales are going to be what?
4,
480. In the fourth quarter, the sales are going to be what?
640.
Okay. But look at what we did. We got our sales quantity for that year. If it was the target launch year, it would be 1,200. But we went on with the break-even year, and we put the 1,600 in. We put the percentages in. What's gonna go on this next line? Selling price, and we said it was $500, correct?
yeah, 500.
So once we get the 500, now we need the sales by quarter. So what's first quarter sales gonna be? That 80,000.
Yes, 80,000.
Second quarter is gonna be what? 160.
Mhm.
Third quarter is gonna be what?
240.
Fourth quarter,
320.
and we add those sales up. How much is this gonna be? If we add them up, what's these total sales gonna be if we add them up?
800,000.
Which just happens to agree with what? That number there. Okay. Let's work with the first quarter by itself. All the sales are credit sales. We could have cash sales, but that complicates it. So I'm just gonna have all the sales credit sales, 80,000. 10% of these sales are never gonna get collected. 8,000, that's your bad debts. So they never get collected. We're gonna collect 40% of these sales this year. I mean this quarter. So these are quarter. So if we collect 40% of 80,000, how much is that?
32,000.
That's 32,000. We have anything to collect since this is the first quarter from the prior quarter. And so our total collections are 32,000. Any questions on that? Are there any questions? So everyone see what we did. And then we're going to take those collections and put them right here on that cash budget. So we've determined how much we had to collect, which is 32,000, which we're going to collect in that first quarter. Our beginning cash balance was what? If we go back to the assumptions, initial cash balance is 200,000. We got to have a minimum of 100. So that's typically the assumption that you'll be using. So beginning cash balance 200,000.
Wait, where do we get the beginning cash balance from?
Your assumptions. So once again, you go back in the assumptions, and you can use this on your project. You have to make a determination of what your initial balance is going to be and what your minimum balance is going to be. So we start the company off with 200,000, and our minimum is going to be 100,000. So remember, we got to determine, do we need to borrow any money in the first quarter? So we got to go through and do this quarterly. Let's go to the second quarter and let's look at what happens. Our credit sales in the second quarter are 160,000. 10% of these are not going to be collected, 16,000. We're going to collect 40% of the 160 this quarter. So that's going to be $64,000. Now watch this. We're going to crisscross over here. The 80 that we sold in the, where we got 40%, we're going to get the remainder of this in this next quarter. So we get 40,000 here by taking 50% of the prior quarter. That is, we only got 40% of that prior quarter in the quarter. The next quarter, we got this. And so our collections are going to be 64 plus 40. That's going to be 104,000. And we're going to take that 104,000 and we're going to put it here. Now your job is to do the next 2 quarters. I've done the first 2 quarters. You're doing the next 2 quarters. Are there any questions on what you need to do? Okay, I'm going to give you about 7 or 8 minutes to do quarters 3 and 4 and get your totals and come up with these collections. So begin work so we can get this cash receipts budget done. This is for the break-even year. For to lose $100,000 a year, we got to do this budget. For the $1 million year, for each year, we'd be doing one of these schedules. So begin work and see if you can get quarters 3 and 4 done. How we coming? How we coming? How much are our credit sales in quarter three?
$240,000.
What's our bad debts gonna be?
24,000.
Collections? Much of the 240 we collecting.
96,000.
40% of this number, 40% of the 240, that's 96,000. Then we got to go back over here and collect the second quarter sales. So how much are we collecting of that this quarter?
80,000.
80,000. What are our total collections?
176,000.
Got the fourth quarter done? Let's take a couple minutes. Everybody work on the fourth quarter.
Can you show how you got to collections of the first month after the sale of 50%? Like what numbers did you calculate to get that?
Okay, you always are coming back uh, to the quarter before. The credit says 80, you collected eight, eight went bad. You collected 40% in the quarter sale, and you collected the other 50% in the next quarter. So you sort of come in category like that. Okay? That's why I gave you that example of how you pay your how a person would pay if they had a deferral. The sale is here, but the cash comes later. Eight of the 80,000, 8,000 is not collected because it goes bad. 32,000 is collected in the quarter sale. 40,000 is collected the next quarter. Got it?
Okay.
Okay, so where are we on the fourth quarter?
So for the credit sales, it'll be 32,000.
You mean 320,000?
Oh yeah, for the credit sales, my bad. It'll be 32,000 for the bad debts 10%.
Okay, 32,000 with a bad debt.
And then
Collection,
for the yeah, that'll be 128,000 for the 40%.
I'll take your word for it. And
And
50%,
then that'll be 120,000.
so what's our
And then
total?
I'm sorry, the total would be 248,000. I'm sorry, Professor Boyd. I'm not trying to keep cutting you off. It's like when you talk, I talk, so I apologize.
No problem, no problem. Just so you're talking. Okay, so and what's our total collection? I guess let's just go across. The sales were 800,000, and of course, they're all credit sales, so we got 800,000. Our bad debts were, we add those numbers up, they're probably 80,000, correct? Add them all up. If we add this line, how much do we get? If we add collections in the month of sale, because I don't have an Excel here, how much would this be? If we add these four numbers, how much is it?
320,000.
How much?
320,000.
Thank you. How much are these sales?
240,000.
For collections, excuse me. What are our total collections? Is that 560?
Yes, sir. It's 560.
Okay. Now, see what this CB is. All of these numbers are going to go on the cash budget. So I think we have a couple of those there. So let's see. I want that. Let's just take these two to the cash budget. I think we said the total was 560, correct?
Correct.
Now, so where we have the CBs, those items go on the cash budget. But where we have the JEs at, and you see this on, I think on the Excel spreadsheet and everything, this is where our journal entries come that we got to make to get to a trial balance. So let's look at these journal entries that we'll be making. And you have to make these on your project. First journal entry is that $200,000 you started uh, the company off with. That's that standard first journal entry. Debit cash 200,000, credit common stock 200,000. Our sales were all on credit, and they were 800,000. So we're bringing down now the 800 and the 80, the credit sales and the bad debts. So 800,000 and 800,000, 80,000, and only by making the journal entries can you have everything tying in. Our collections, we said, were how much?
That was added together.
Yep, how much was it?
560,000.
560. Should have been. Hopefully, you see how from that fourth column you get the numbers for the journal entries. So with the schedules, as I indicated earlier, two things are happening. First of all, we determine the collections that go on the cash budget, but then we're going to be coming up with the journal entries that we would need eventually so that we can get a trial balance so we can prepare an income statement and a balance sheet. Now, there's one final journal entry we have here, correct? What's this journal entry? What is this journal entry? We know that when we sell inventory, we record the sale. We record the sale of the inventory. And let's see if we can look at the discussion about that journal entry. So as you prepare a schedule, when you're first preparing them, you want to go through these items. So here's a sales budget. You can see we've done all of these things. Purpose, the units from the CBP formula, quarterly sales, calculate sales quantity, selling price, calculate total sales back, bad debt. We did all of that. Blah, blah, blah. And then we've got to get this file journal entry. And it says that we get the dollar amount by taking the sales quantity times total unit direct materials and direct labor costs. It's the number we sold times total unit materials and labor only. So in the problem, and I think on the spreadsheets, I put in a subtotal here. Let me see if I can insert below. And I have a sub here for product variable costs. And the product variable costs here, as well as on your project, consists of the ink, the paper, and the labor. So that would be how much? $100. When we add these others, we'll get to the 250. But you got to separate out raw materials and labor. Once you get that number, which is 100, and our quantity sold, remember, was how many did we sell? 1,600. So to get this number, we're going to multiply the quantity sold times that cost. So 1,600 times 100, and that's going to give us a cost of goods sold of what?
160,000.
So we have our journal entries and our sales schedule done. Got that first schedule done. And so you'll be having a quiz on your project where you're going to have to do just what we just did. Complete for your project. Probably I want that by next Thursday. The sales budget and those journal entries. So let's look at where we are now. We got a cash budget and we have the beginning cash, what we have available. Now we got to go quarter by quarter to determine what's the total payments and whether we need to borrow. So whereas before we just had two numbers, now we've got ink, paper, labor, manufacturer overhead, selling expense, administrative expense, long-term note and interest. We have all of those that we've got to do. So we have to begin to attack the remaining of the budgets. And the first budget is the sales budget. And the first line on the sales budget are the sales quantities. I know last semester people gave me the sales dollars, but those sales quantities come here, okay? Now we're just going to do the first quarter. You got to make 160 because you sold 160. But we want 50% of these produced also in the first quarter, so they are available on the first day of the quarter. So we got 160 that we sold plus 50% of this number. It's going to be 160. So we got to produce 320 in the first quarter, okay? We got to produce 320. What we sold, half of what we're going to sell next quarter. We don't have any beginning inventory, so this number becomes 320. Now, there are no dollars on this budget and no journal entries. But once we get this 320, it comes on to the raw materials budget as the top number, unit to be produced. On the other raw materials budget, and on the direct labor budget. So you can see that if this number is incorrect, then a bunch of your budgets will be incorrect. So that means this number has got to be correct. And it means that that 1600 you calculated has to be correct. So you take that time to prove it and make sure it's going to work. Because as you see, you're going to have a lot of budgets in trouble. Now let's see if we can work on the ink budget. We got to go through each one. It says it takes 5 ink cartridges at $10 a unit. And this is the assumption about the design and the inventory here. We got to have 5 ink cartridges at $10 each. So the per unit requirement is 5. And the unit cost is going to be 10. So how many ink cartridges we got to buy?
$1,600.
I'm going to take your word for it. The unit cost is $10 each. So what? How much is it going to cost us?
It's 16,000.
Okay. Now, how are we going to pay the 16,000? We go back to the assumptions, and the assumptions say on the raw materials, we pay 75%. This should be the month of purchase here. Then we pay 25% a month after purchase. So we got 16,000, but we only paying 75%. So we're paying 75 of this month of this number. So what's 75% of 16,000? 12,000 typically. We get the 12,000 and we take that 12,000 and we put it right here for the ink. 12,000. We got to do that for the paper and we got to do it for the labor. Okay. We have to do it for each one. Some of these are very easy to work with. Let's take manufacturing overhead. So we'll just jump down to manufacturing overhead. We go to our assumptions. The manufacturing overhead that we had to pay was 25,000, but 10,000 of it included depreciation. So that's not a cash expenditure. So when we get the manufacturing overhead, we put 25,000 here. We subtract out the depreciation. The manufacturing overhead is going to work just like that. So the total payment is going to be 15,000 for manufacturing overhead. The administrative expense is going to work the same way, just like manufacturing overhead. Total cost less depreciation. And of course, this is your in-class problem that each team has to work. I've done ink, so you'll do paper. Let me help you. Let's look at direct labor. And you did 20, you had to make 20 books per hour, and the rate was $20 an hour. So the per unit requirement was 20 per hour. And the labor rate was also $20. So how many hours are they gonna work?
Would it be 16?
It'd be 16. How'd you get 16?
I divided through 20 by 20 since they can make 20 books in 1 hour.
Okay, so this is 16. So how much is the direct labor gonna be then that you gotta pay that quarter? Maybe $320?
Yes.
You take 320. So what I want you all to do by next Monday is to have the schedule finished for me. Any
Okay.
question? Any question on what you're doing?
So next Monday we having
Next two.
basically everything from this filled out, and then on that Tuesday, that's when the project part 2 is due.
Yeah. this, all of us be doing on Tuesday, because this example, when we go through it, you got to do everything that we do in this example on your project. So you're gonna have those assumptions and everything down. I tell you to go and buy your raw materials and everything. You have to have all of that laid out for me on Tuesday. Then on Tuesday we'll finish this problem up, but you all be doing the talking. So to get this finished. So we'll go through it, but you should be able to now to have a sense of what you've got to do to determine what your total cash payments are going to be and whether you need a short-term loan or not. So on Tuesday, I'll check, we'll go through and get the first quarter and second quarter totally done. Then you're going to have to do the remaining quarters. Then you have to make all the journal entries, prepare trial balance, and eventually prepare the income statement and balance sheet. And when we get that done on this example, which should be done by at least Thursday, then you got your model for your project. Any questions? Excel, of course, is your friend. And I think I have the templates in there, correct? If not, I'll put them in. But you want to do this in Excel and put your formulas in for this problem. Then you zero out those numbers and make the adjustments and then do your template. Got it? Good. Well, you all have a pleasant holiday period and don't eat too much turkey. And I will see you all on Tuesday.
See you Tuesday.
Don't say it excited. See you on.
Happy Thanksgiving, Professor Boyd. See you Tuesday.
Okay.
Happy Thanksgiving. See you Tuesday.
Okay. Victoria and Connor, you all still there? Victoria, are you still there?